somewhere between here and $750 million. There's a version of you standing in a parking lot outside a 12-unit apartment building in a city nobody's writing think pieces about, holding a folder with $40,000 of your own money in it, and a phone full of unanswered texts from people you're about to ask for a lot more than that. That's level 1, not the penthouse, not the private jet card. A cracked parking lot and a spreadsheet you've rebuilt 14 times because the numbers keep almost working. You need to understand what you're actually building before you can build it. A real estate syndication, stripped of the jargon, is just this. You find a deal too big for your own money to buy alone. You bring in other people's money to close the gap. You do the work, the running, the fixing, the reporting. They get a return on capital they'd never have deployed themselves. In the language of the business, you're the GP, the general partner, the one who sources the deal, signs on the debt, and operates the asset. They're the LPs, the limited partners, the ones who wire money and wait for distributions. Neither side gets the deal without the other. You don't have the capital. They don't have the deal, the time, or usually the appetite to run a building at 6 a.m. when a pipe bursts. That gap between what you have and what they have is the entire business model, and every level from here to $750 million is just that gap getting wider on both sides at once. Your first deal is small enough that it's almost embarrassing to call it a syndication at all. 12 units, maybe 16, a tired brick building in a secondary market where the seller is motivated because his property manager just quit and he's tired of the phone calls. Purchase price somewhere around $900,000. You're not walking in with institutional money. You're walking in with $35,000 to $50,000 of your own savings, the kind you've been sitting on for 2 years specifically for this moment, plus 5 or 6 people you actually know. A cousin, a guy from your old job who did well in software. Your father-in-law who asks more questions than everyone else combined. Together, they get you to the $200,000 to $250,000 in equity you need to close, alongside a bank loan covering the rest. This is where the fee structure gets built into the deal, and it's worth understanding now because it never really changes, it just gets bigger. You take an acquisition fee at closing, typically 1% to 2% of the purchase price, compensation for the months of work it took to find the deal, underwrite it, and get it to the closing table. On a $900,000 deal, that's somewhere around $9,000 to $18,000. Not retirement money. Barely gas money once you count the hours. Then there's an asset management fee, usually 1% to 2% of collected revenue annually, paid to you for actually running the thing once it's yours. And then there's the promote, sometimes called the carry or the waterfall, which is the real engine. Your investors get their capital back first, plus a preferred return, usually 7% or 8% annually, before you see a dime of profit above your fees. After that preferred return is met, profits split, commonly 70-30 or 80-20 in the investor's favor at this level, because you have no track record and they're the ones taking the risk on an unproven operator. That split matters more than it looks like on paper, because it tells you something you won't fully feel until you're in it. At level 1, you are not being paid for your money. You barely have any. You're being paid, eventually, for your judgment and your labor, and only after everyone else has been made close to whole. Which means the real lesson of your first raise has almost nothing to do with cap rates or debt service coverage ratios, even though you'll spend 3 weeks convinced it does. Here's what actually happens when you try to raise your first $250,000. You build the deck. You build the spreadsheet with the sensitivity analysis and the 5-year hold projections and the exit cap rate assumptions, and you send it to 20 people, and 11 of them don't respond, and 6 of them ask polite questions that go nowhere, and 3 of them say yes. The 3 who say yes don't say yes because of the spreadsheet. They say yes because they've known you for 6 years, or because they watched you manage your own rental property without losing your mind, or because your cousin vouched for you at Thanksgiving, and that carried more weight than 11 pages of pro forma. You will not believe this until it happens to you, but the first $250,000 you raise is a trust transaction wearing a finance costume. Nobody underwrites you on cap rate assumptions when they've never seen you close a deal before. They underwrite you on whether you've ever let them down about anything smaller first. This is also where you'll make the mistake almost everyone makes, and you won't know it's a mistake until 18 months later when the roof needs $22,000 in repairs you didn't budget for. New syndicators underestimate reserves because reserves feel like dead money sitting in an account instead of working for anyone, and dead money is uncomfortable when you're trying to hit a return number that gets your investors excited. So you trim the reserve line from 5% of revenue down to 2%. You project rent growth at 5% annually because the market comps from the last 2 years support it, ignoring that markets don't move in straight lines forever. You tell your investors to expect an 8% cash-on-cash return in year one because that's the number that got the last two maybe responses to turn into yes. Then a unit sits vacant for 4 months longer than planned, and the water heater in Unit 7 dies the same month as the HVAC in Unit 3, and suddenly you're on the phone with your father-in-law explaining why this quarter's distribution is smaller than promised. Nobody taught you this in a course. You learn it the way everyone learns it, by underfunding the thing that was supposed to protect you from exactly this and eating the difference personally so the wire still goes out on time. That first deal, with its $18,000 acquisition fee and its humbling reserve shortfall and its 6 investors who now trust you slightly more because you handled the bad news honestly instead of hiding it, is level 1. It's not impressive. Nobody's writing about it, but it's the only door that opens the next one because the next raise isn't $250,000 anymore, it's $2 million. And the investors calling you this time aren't your cousin's friends, they're people who heard about the deal from someone else entirely. That's the shape of every level from here forward. The portfolio gets bigger, the capital stack gets more complicated, the mistakes get more expensive, and the trust you're spending against gets rebuilt level by level, deal by deal, all the way to a number that would have sounded made up to the version of you standing in that cracked parking lot. Level 2 doesn't feel like a new level when you're standing inside it. It feels like relief. You've got one deal that's cash flowing, 6 investors who got paid on time 3 quarters in a row, and a phone that started ringing instead of you doing all the calling. You buy a second 12-unit, then a 14-unit 18 months later, and now you're sitting at $5 million in assets under management without ever having sat down and decided to build a portfolio. You just didn't want to stop. This is where the investor list starts to matter more than any single deal. Not a spreadsheet of names anymore, an actual list, the kind you update after every call, sorted by how much someone can write, how fast they move, and whether they ask about the exit strategy before or after they ask about the swimming pool. 3 of your original 6 come back for deal number 2 without you asking twice. That matters more than it sounds like it should because a repeat LP isn't just capital, they're proof. When a new investor asks who else is in the deal, people who've already been paid by me once is the only sentence that closes faster than the pro forma. By $15 million, you're not raising from 20 people to get 3 yeses anymore. You're raising from your list, and the list is raising itself because your cousin's coworker mentioned you at a dinner party you weren't at. Level 3 is where the business stops fitting inside your own calendar. Somewhere between $25 million and $50 million, you hit a wall that has nothing to do with deal flow and everything to do with hours. You're underwriting new acquisitions in the morning, walking a property with a contractor at noon, and writing an investor update at 11 p.m. because that's the only slot left, and it shows. Typos. Numbers that don't tie out to the K1 from last quarter. An investor emails asking why his distribution date moved for the 3rd straight month, and you don't have a good answer because you genuinely lost track, buried under 3 properties instead of 1. So you hire. First hire is almost always an asset manager, someone whose entire job is the buildings themselves, the vendors, the make-ready timelines, the occupancy reports, so you can go back to doing the thing that actually grows the business, which is finding the next deal and the next check. Second hire, usually not far behind, is a capital raiser, someone dedicated to the investor relationships full-time, someone who can get on a call with a prospective LP at 2 p.m. on a Tuesday because you're on a property walk in another state. This is also exactly where you finally systemize investor reporting, because systemize sounds like a boring word until you've personally reconstructed a quarterly report from 3 different spreadsheets at midnight and sworn you'd never do it again. You move to a real investor portal, automated capital account statements, K1s that go out on a schedule instead of whenever you find the time. It's not glamorous. Nobody posts about their investor portal. But it's the difference between running 3 deals and running 30, and at $25 to $50 million, you're finding out in real time which one you're actually built for. If you want the version of this that goes deeper than I can cover here, the fee structures, the specific mistakes people make scaling their team too early or too late, the actual math behind why some GPs blow up at exactly this stage, there's a book that walks through all of it deal by deal, and it's discounted this week. Links below if you want the fuller breakdown while you're at it. Worth having on the desk for this exact stretch, because this is where the mistakes stop being cheap. Because here's the part nobody puts in the caption. Debt gets more complicated at almost the exact same speed the team does, and if you don't understand that shift, it'll cost you more than a bad hire ever could. At level 1, you took a conventional bank loan, fixed rate, boring, forgettable. By level 2 and 3, you're leaning on bridge loans to move fast on value-add deals, short-term, higher-rate debt that lets you close in 3 weeks instead of 3 months, with the plan to refinance once you've raised rents and stabilized the property. Bridge debt is a tool, not a trap, but only if you actually execute the business plan on schedule. By level 4, at $75 to $150 million, you're moving into agency debt, Fannie Mae and Freddie Mac loans, the kind that come with better terms, longer amortization, non-recourse structures that protect you personally, but also come with underwriters who want to see real financials, real reserves, real property management history before they'll touch you. And somewhere in there you learn what an interest rate cap actually is. Not from a textbook, but from a lender requiring you to buy one on a floating rate bridge loan, a hedge that caps how high your interest payment can climb if rates move against you mid-hold. You pay maybe $40,000 for a cap on a $12 million loan, and the first time you write that check, it feels like paying for insurance against weather that hasn't happened yet. Then rates move, and you understand exactly why every experienced GP told you never to skip it. Level 4 is also where the entire fundraising motion flips on its head. Deal by deal, you'd raise for one property at a time, courting the same list every few months, hoping the timing worked for enough of them to hit your number. At $75 to $150 million, that stops scaling. You start raising fund-level capital instead, a blind pool, or a discretionary fund where investors commit capital upfront to a strategy, not a single address, and you deploy it across multiple acquisitions as they come. It's a fundamentally different pitch. Instead of here's the building, here's the pro forma, it's here's my track record, here's my thesis, trust me to find the buildings. And the people writing those checks are not your cousin's coworker anymore. Family offices start showing up on your cap table, the quiet money managing wealth for a single family across generations, along with smaller institutional allocators who write checks in the millions, but ask questions your original 6 investors never would have thought to ask. Debt service coverage stress tests, key man risk. What happens to the fund if you personally get hit by a bus? It's not colder, exactly. It's just a different language. One built by people who've been burned by operators before you and want it in writing that you won't be the next one. And this is the exact point where the recurring risk of this whole stretch shows up, the one that takes down more syndicators than a bad market ever does. It's not a bad deal, it's growing faster than your team or your systems can actually carry. You raise the fund, you close 3 properties in 5 months because the capital's sitting there and the deals are there and it feels irresponsible not to move, and then you realize your one asset manager is now covering properties in 4 different markets. Your reporting cadence slips because the portal update that used to take an afternoon now takes a week, and the debt you took on to move fast assumed a stabilization timeline your under-resourced team can't actually hit. Over-leverage isn't only a financing term. It's operational too. Growth outrunning the humans and the processes underneath it, and it's the single most common reason a GP who looked unstoppable at $100 million ends up explaining a capital call to investors who thought they were done writing checks. The portfolio at $150 million looks nothing like the 12-unit building in the cracked parking lot. Different debt, different investors, different teams sitting between you and the tenant with the broken water heater. But the question underneath it is exactly the same one you asked at level 1, just with more zeros attached. Can the thing you built keep its promises faster than it grows? Get that wrong here, and the next level doesn't just get harder. It gets a lot more expensive to survive. Level 5 doesn't announce itself with a deal. It announces itself with an org chart, somewhere between $250 million and $500 million in assets under management. You look up from your desk and realize you're not running a syndication anymore. You're running a company. A real one with departments, headcount, a P&L that has line items you didn't know existed 2 years ago. Acquisitions is its own team now, not you and a broker's cell phone number. You've got analysts underwriting deals full-time, running comps, stress testing rent growth assumptions, killing 90% of what crosses their desk before it ever gets close to your inbox. Asset management has split off from the one guy you hired back at level 3 into a group with regional managers who each own a slice of the portfolio, who report up through a VP who reports to you, and who you'll meet maybe twice a year unless something's on fire. And investor relations, the thing you used to do yourself on a Tuesday afternoon call, is now a department with its own director, its own reporting calendar, its own dashboard tracking which LPs re-up and which ones go quiet before a capital call. You didn't build this because it sounded impressive. You built it because the alternative was drowning. At $50 million, you could hold the whole business in your head. At $300 million, you can't. Nobody can. The properties are spread across enough markets and enough debt structures that keeping it all in one person's memory isn't a flex anymore. It's a liability, the kind that shows up in an investor update 3 weeks late because you personally forgot a distribution date buried under everything else. Level 6 is $750 million, and this is where the shape of the business changes again, not just the size of it. You're not concentrated in one market anymore. You've got multifamily in 3 states, maybe some industrial or self-storage mixed in because a market cycle taught you the hard way that one asset class getting soft can drag your whole portfolio if it's all you own. You're negotiating directly with lenders now, not shopping around for whoever will approve you fastest. Life insurance companies, CMBS desks, the relationship people at Fannie and Freddie who know your name because you've closed a dozen loans with them. You're not the guy applying anymore. You're the guy they're calling because they want your business on their books. Same thing on the equity side. Family offices that used to write you a $2 million check now commit $20 million across a fund, sometimes with a side letter negotiating their own fee break, because at that size, they can ask for one and get it. Institutional allocators show up with term sheets instead of questions. And somewhere in all of this, your own role has quietly flipped inside out. You started as the person who found the deal, walked the property, knew the tenant with the broken water heater by name. Now you're a capital allocator. You decide which markets get money and which don't. You're a brand builder, because at $750 million, your name and your track record are the product being sold to LPs who will never see a single building you own in person. The deal doing happens 3 layers below you now, and if you're still the one underwriting individual properties at this size, something in the org chart is badly broken. Which brings us to what actually breaks at scale, because something always does, and it's rarely the thing new operators worry about. It's not finding deals. Deal flow gets easier the bigger you get. Brokers bring you the good stuff first because they know you can close. What breaks is everything downstream of the deal. Reporting complexity is the first casualty. At level 2, one spreadsheet covered your whole portfolio. At level 6, you've got dozens of entities, each with its own operating agreement, its own waterfall, its own K1 timeline, and if your systems weren't built to scale years before you needed them to, you find out the hard way, usually in the form of a fund audit that takes 4 months longer than it should because nobody can reconcile capital accounts across entities that were structured slightly differently by 3 different attorneys over 6 years. Compliance and securities law exposure is the second one, and it's the one that actually ends careers. Every time you raise a new fund, every time you bring on a new class of investor, every time you cross state lines with a general solicitation, you're operating inside securities law, and the rules that felt like paperwork at $5 million become existential at $500 million. A Reg D exemption filed late. An accredited investor verification that wasn't documented properly 3 funds ago. A general solicitation rule violated because someone on your marketing team posted the wrong thing at the wrong time without knowing what a solicitation even means legally. These aren't hypothetical. These are the actual mechanisms that have taken down operators who looked untouchable at this size, and most of them didn't see it coming because compliance doesn't feel urgent until the SEC letter arrives. And the third thing that breaks is investor communication at volume. At level 2, you personally called 6 people. At level 6, you have thousands of LP relationships across multiple funds, and the personal touch that built your original investor list doesn't scale linearly, no matter how good your IR team is. Somebody always feels like a number. Somebody always finds out about a capital call from an email instead of a phone call, and that person talks, and at this size, reputation moves faster than any deal you can close. So here's the whole climb, laid flat. Level 1 was 1 deal and a dozen investors, proving you could do what you said you'd do. Level 2 was a portfolio built by accident, because you didn't want to stop after the first win. Level 3 broke your calendar and forced you to hire. Level 4 flipped your fundraising model from deal by deal to fund level and introduced you to family offices and interest rate caps. Level 5 turned you into an actual company with departments doing the work you used to do alone. And Level 6, $750 million, turned you into an allocator of capital and a name on a track record instead of a person who's ever laid eyes on half the buildings you own. Every level up, the mistakes get quieter and more expensive. And there's one specific mistake sitting inside almost every fund structure at this size, a securities compliance gap around accredited investor verification that most operators don't even know exists until roughly 18 months in, usually right when they're raising the next fund and a lawyer doing diligence finds the hole. By then it's not a fix, it's a disclosure, and it can cost six figures in legal cleanup before you ever raise another dollar. That's the kind of mistake that doesn't show up on a spreadsheet. It shows up in a deposition. If you want the fuller breakdown of exactly where that gap hides and how operators structure around it before it finds them, there's a book that walks through it in detail. Links in the description below.